There is a strange contradiction at the center of the modern world. Every nation carries debt, every government borrows, and every economy depends on credit to function and grow. We work, we save, we spend, and yet the system itself runs on money that does not yet exist. If countries owe trillions, corporations owe trillions, and households owe trillions more, the question becomes unavoidable. Who is the world actually in debt to, and how can the system continue operating if everyone owes and no one can ever fully settle the balance? The answer is not a hidden vault filled with gold, nor a secret group controlling the world from the shadows. The answer is a financial structure built gradually over centuries, designed to keep money circulating, economies expanding, and credit continuously flowing. It is a system that transforms future productivity into present purchasing power, allowing societies to function today based on expectations about tomorrow and encouraging constant growth to sustain stability. Because this system surrounds us from birth, it feels natural and permanent. We earn wages, use banks, take loans, invest savings, and rarely question the mechanisms underneath. Yet the modern financial structure was not inevitable. It emerged during moments of crisis, war, and economic stress, when leaders faced impossible choices and created new tools to sustain their nations, tools that gradually reshaped the global economy we now depend on. To understand why the economy functions the way it does today, we have to look at the moments when its rules were rewritten. Financial systems rarely change during stability. They change during crisis. In calm periods, societies preserve tradition, but in times of pressure, they invent solutions that reshape the future. The architecture supporting modern money was not designed in comfort. It was forged in emergencies, when survival required innovation rather than caution. In 1694, England faced a crisis it could not finance through taxation alone. War demanded resources faster than revenue could be collected, and traditional methods were too slow. The solution was unprecedented. A private institution would lend money to the government, and in return it received the authority to issue banknotes backed by that debt, creating a new relationship between state power, credit, and the supply of money. The Bank of England did more than fund a war. It established a model that would change economic history. Governments could borrow to spend immediately, repay gradually, and expand beyond the limits of physical gold reserves. Money was no longer only metal extracted from the earth. It could be created through lending, multiplied through trust, and circulated through an expanding financial network connecting trade, banking, and national power. This idea transformed economic expansion. Credit allowed governments to finance infrastructure, merchants to fund voyages, and industries to grow faster than available capital would normally allow. Debt was no longer viewed solely as a burden. It became an instrument of growth. Nations that mastered credit expanded trade networks, strengthened military power, and accelerated development beyond anything the previous gold-limited system could support. Over time, other nations adopted similar institutions. Central banks emerged to stabilize currencies, manage liquidity, and serve as lenders of last resort during financial crises. These institutions became the invisible stabilizers of modern economies, stepping in during panic to restore confidence and prevent systemic collapse, reinforcing the trust required for money to function effectively. But stability brought an important trade-off. For this financial system to function smoothly, credit had to continue expanding. Loans create money, while repayment removes it from circulation. Without new borrowing, liquidity contracts and economic activity slows. Growth, therefore, becomes dependent on continuous expansion of credit, making borrowing not an exception but a structural requirement of modern economies. This dynamic changed how societies understood money. Instead of viewing debt solely as a danger, governments and businesses began to see it as a tool for acceleration. Borrowed capital could build infrastructure, fund innovation, and expand production long before profits existed. When used responsibly, credit compressed time, allowing the future benefits of growth to be brought forward into the present. A decisive turning point arrived in 1971, when the United States ended the direct convertibility of the dollar into gold. Until that moment, the global monetary system was anchored to a physical reserve that limited expansion. Once that link was removed, the dollar became fully fiat, supported not by metal stored in vaults, but by economic strength, institutional credibility, and global trust in the stability of American financial power. This transformation gave governments and central banks unprecedented flexibility. During recessions, liquidity could be injected rapidly to stabilize markets and prevent systemic panic. Financial shocks that once triggered cascading bank failures could now be contained through coordinated intervention. The modern system became more resilient, capable of absorbing stress that might previously have produced deep deflation and widespread economic collapse. With fiat currency, value no longer rests on metal reserves but on confidence in the institutions that manage money. As long as citizens trust their currency, accept it in exchange, and believe it will retain purchasing power, the system functions smoothly. But trust is intangible and fragile. If confidence weakens, capital moves, currencies fluctuate, and stability depends not on golden vaults, but on credibility, policy discipline, and belief in long-term economic strength. As credit expanded across the globe, economies became more interconnected than at any other point in history. Capital began moving across borders instantly. Investments flowed between continents, and financial markets reacted to events in real time. A decision made in one country could influence currencies, markets, and interest rates worldwide within hours, creating a level of interdependence never before experienced. This growing interconnection accelerated global prosperity, but it also introduced a new form of systemic risk. When markets become tightly linked, stability can spread rapidly, yet stress can spread just as fast. Financial disruptions no longer remain local events. A banking crisis, supply chain failure, or currency shock in one region can trigger cascading effects across continents, influencing credit conditions, investment flows, and economic confidence around the world. History shows that financial systems rarely fail without warning. Pressure builds gradually beneath the surface, often unnoticed by the public. Asset prices begin rising faster than incomes, debt obligations expand steadily, and economic growth becomes increasingly dependent on stimulus and low interest rates. These signals do not indicate immediate crisis, but they reveal structural tension accumulating within the system. When economic stress emerges, central banks respond by lowering interest rates, expanding liquidity, and stabilizing markets to prevent panic. These measures protect employment, safeguard savings, and maintain financial stability in the short term. Yet they also encourage additional borrowing and risk-taking, reinforcing the cycle and extending reliance on credit as the primary engine of continued growth. This creates a paradox at the center of the modern financial system. To prevent contraction, credit must expand. To stabilize markets, liquidity must increase. To support growth, borrowing must continue. The same mechanisms that preserve stability in the present can deepen long-term dependence on expansion, making the system increasingly sensitive to any disruption in confidence or liquidity. Despite these structural pressures, the modern financial system continues to function because confidence remains intact and institutions continue to operate. Markets open each morning, transactions settle, salaries are paid, and trade continues across borders. Stability does not require perfection. It requires trust and continuity. As long as participants believe the system will function tomorrow, they continue to engage with it today. Confidence, however, is not permanent or automatic. It must be reinforced through stability, transparency, and the perception that institutions remain capable of managing crisis when pressure emerges. When trust is strong, markets absorb shocks and recover with surprising resilience. But when confidence weakens, volatility rises, capital moves rapidly across borders, and financial conditions can tighten with alarming speed, affecting businesses, households, and entire economies. What distinguishes this present era is not the existence of debt or credit, but the scale, speed, and interconnection of the global financial system. Capital flows across continents in seconds. Markets react instantly to new information, and financial decisions in one region can influence economic conditions worldwide before a single business day has ended, linking stability and risk across the entire global economy. At the same time, geopolitical shifts are quietly reshaping the financial landscape in ways that are subtle but increasingly significant. Nations seek greater monetary independence, diversify currency reserves, and explore alternative payment systems to reduce vulnerability to external pressure and financial sanctions. These adjustments do not signal immediate collapse, but they reflect adaptation to a changing balance of economic power, technological capability, and strategic autonomy in an interconnected world. Financial systems have never remained static throughout history. They evolve under pressure, adapt to new realities, and transform in response to crisis, innovation, and shifting balances of power. What appears permanent in one era often proves temporary in the next, not because it fails instantly, but because conditions slowly change around it. Stability is not the absence of change, but the capacity to adjust without breaking, allowing complex economies to continue functioning even as the foundations beneath them evolve. Understanding the global financial system does not require fear. It requires awareness and perspective. Money, credit, and debt are tools shaped by human decisions, incentives, and historical pressures that have evolved over centuries. The system is not designed to end, but to adapt, absorb shocks, and continue operating through periods of uncertainty. The future will not be determined by debt alone, but by how societies manage growth, preserve trust, maintain stability, and respond intelligently to change in an increasingly interconnected world.